Hello and welcome to 3-Minute Real Estate. I'm Richard Berry, broker associate with the Ciscos Group Realtors in Overland Park, Kansas. Welcome to episode 2 of Buying Investment Real Estate Properties, Goals and Measures. In this video, we'll discuss how investment property makes income and how to define your goals. If you've taken the first steps mentioned in the first episode, the next step is to define your financial goals with the help of your team. You should set short, medium, and long-term goals. To do that, you need to understand the three main ways that investment properties generate income. Appreciation. Usually properties increase in value or appreciate. In the past year, homes in Johnson County have increased in value around 5%. That's a direct increase in your net worth. If you sell that property at market value, you will get that value out. Cash flow. Your cash flow is your net income after expenses and reserves. Investment property is like stocks. A stock has a value when you sell it, and a stock also can have dividends paying you regularly. Depreciation. When you buy income-generating property, the IRS says that it has an economic lifespan of 27.5 years. That means the value decreases or depreciates by a little over 3.5% of the original value each year. That is a loss, on paper at least, against your income. In other words, you get a bit of a tax shelter each year for the property you own. However, it turns back to profit if you sell the property. There are other things to consider, such as the tax write-off on mortgage interest and possibly other income from services offered at the property, such as pay washers, dryers, things like that. But these are the basics. You'll want to set your goals for each property. How much cash flow are you wanting? How important is the appreciation of the property itself? What mix of returns do you want? You'll also want a way to measure and compare properties to determine which is the best fit for your investment strategy. Different investors use different measures. Some use cash on cash, where the annual return is measured against the amount of cash invested. Others use return on investment, which is the annual return measured against the total investment. There are still other ways to measure, such as cap rate, gross rent multiplier, and others. Work with your team to determine the best way to measure for you. Next, you want to think about your market focus: single family, multifamily, or higher density. Higher rent, lower rent? Some of this will be determined by your finances and your financial goals, but it's also informed by your own desire. There are trade-offs to different markets. Let's look at the trade-offs of single versus multifamily dwellings. For single versus multifamily units, the trade-offs are: single-family homes have less dollar-for-dollar return in general, where multifamily usually does better. In vacancies, single-family homes are all or nothing. A vacancy yields no return, while rental yields full return. Multifamily units spread that risk across multiple units. Single-family units can be nicer and offer more stability for income. Multifamily units can have more churn of tenants. Next time, we'll finish looking at target markets, then move on to getting your first property. I hope you're enjoying 3-Minute Real Estate. If you have any suggestions, questions, or comments, please feel free to reach out. If you're looking for a realtor, I'd be honored to help. See you next time.